Hello, everybody. This is Jim Steiker with SES Advisors. Welcome to our webinar on issuing warrants in ESOP transactions. In the next hour or so, we're going to talk about how warrants are used in ESOP transactions, some of the tricks, traps, valuation concerns, and the like. Please note that the conference is being recorded. I have muted all of the other participants so we won't have any background noise issues. You can ask questions through the chat function. I will try and take questions as they are asked as we go through the presentation. So first of all, what are we going to talk about today? We're going to talk about what are these things called warrants and how are they used in an ESOP transaction. We're going to show some of the typical warrant structures. We're going to show and talk about how warrants can be valued for financial and tax purposes. We'll talk a little bit about the tax treatment of warrants and talk a little bit about some of the concerns that fiduciaries may have in dealing with warrants as part of a transaction. So first of all, what in the heck are these things called warrants? Warrants are basically a financial instrument. They grant the holder of the warrant the right to purchase stock at a future date or during a future period of time at a specified strike price set today. And that's basically what a warrant is. It's generally synonymous with the idea of a stock option. A warrant is simply a term that is used to describe a stock option that's attached to another financial instrument as opposed to an option which is typically a standalone. So that's basically what a warrant is. So normally you'll see a warrant as an option attached particularly to a debt instrument in the ESOP context, but it can also be attached to a common stock or something else. It can be used in almost any context. And why do we use warrants in corporate finance transactions? The most common use of warrants really is as an equity kicker, if you will, to augment the rate of return on a debt instrument issued by a corporation. It's a sort of conditional extra payment. So, for example, suppose I have a corporation that wants to borrow money, and we don't have any senior debt capacity. The bank won't loan us more money. We don't really have collateral. Somebody who is going to lend money to us might expect, as a subordinated lender or mezzanine lender, a very high rate of return on that loan, maybe 16-18%, for example, and we really can't afford to pay that kind of cash interest to borrow money. So maybe hypothetically instead we will issue an investment unit consisting of a note for the loan amount. Maybe we'll pay some level of fixed interest, maybe perhaps 8%, just making up a number. And then the remainder of the return that we're going to give to our investor here would be a warrant with a present value sufficient to provide the lender with the remainder of its expected return. So I might give a warrant that when exercised we expect to have a value that would be enough so that the total return on the investment would be 16 or 18%, but the warrant would be conditional on how our underlying stock was doing. So it would align the debt investor to some degree with the performance goals of the company. So let's talk about ESOPs. In ESOP transaction finance, ESOPs, as we know, are generally leveraged transactions. That simply means that by and large we're borrowing money somewhere in the middle of the transaction to purchase, to help the ESOP purchase stock from shareholders or from the company. And often the borrowing we would like to have the ESOP do is often in excess of what the company can comfortably and simply borrow from a senior lender, who lends, of course, basically measured by company cash flow and collateral. And the simplest examples, lots of times we have companies that are trying to become 100% ESOP owned, perhaps particularly because as a 100% ESOP owned S corporation, there'll be no taxable income attributed to any of the shareholders currently. And so we may want to be borrowing more money from somebody to make sure we can buy 100% of the stock. And often in ESOP transactions, the debt over and above what a bank will comfortably loan on a senior basis is being held by the selling shareholder, or sometimes there's a third-party investment by a junior capital provider or even a private equity group. So the debt we have to a selling shareholder in any given transaction may have the financial attributes of any or all of senior debt, subordinated debt, or really even equity, particularly when we're borrowing 100% of the value of a company to finance 100% ESOP buyout. And in those transactions where we have debt in excess of senior debt capacity and we need to pay an enhanced return, very often the company will be issuing some form of a warrant to a selling shareholder or perhaps a third-party capital provider to augment or goose up the underlying interest payments so that those investors can hit an overall return that's appropriate to the nature of their investment. So we see a lot of warrants with ESOPs doing large leverage transactions, typically to get to 100%. We also do have some other sort of odd incidental uses of warrants in ESOP transactions, which is sometimes we have a disconnect between the seller and the ESOP on price. Seller says, my company is worth a lot more. ESOP appraiser says, well, maybe, but there's a lot of contingencies. And so maybe we will sometimes use a warrant issued by the company as a potential contingent payment to the selling shareholder, basically saying, boy, if you're right and the company does great, you get a piece of that performance. And so it's used as a substitute for an earnout, which may be something that may or may not be feasible within the structure of an ESOP transaction. The other way we've really seen warrants used is as a replacement security. When we're pretty close to 100% ownership, but we're not already there and we need to get there. So imagine somehow we've got an ESOP that owns 85% and we have 15% held in small amounts by various management or legacy parties, and they don't really want to give up their ownership per se, or they don't want to give up the piece of the equity, but we want to get to 100% ESOP ownership and not have to deal with tax distributions and the like. Very often we can see a sort of exchange where the outstanding stock is exchanged for a little bit of cash and a warrant that's close to the amount of dilution that the stock represented, whereas essentially we've replaced the outstanding stock with a stock option. And from the seller's point of view, the good news is we'll continue with a capital gains event, and the only thing we have to worry about there is making sure, as in all warrant situations, we don't have 409P concerns, which is too high a concentration of synthetic equity in too few people. So let's see a little remedial ESOP transaction structure here. Here is a diagram in what we see as a typical seller-financed ESOP S corporation transaction. We may be getting some cash from a third party like a bank, and so some of the company stock that the company is redeeming from the shareholders may be paid for with cash, but most often what we're doing is we are redeeming at least some, if not all of the company stock through the company delivering a subordinated note with warrants attached to the selling shareholders, and then typically the company is separately perhaps issuing stock, newly issued shares to the ESOP in exchange for a note from the ESOP. And what this has the virtue of doing when we structure deals this way is an ESOP really can't issue warrants very easily, but a company can. And it lets the shareholders deal directly with the company rather than engaging in a regulated transaction with the ESOP. And it lets the ESOP buy its stock over a period of time determined by the length of time of an internal loan without having it referenced to how fast we actually pay out the shareholders. So the term of the subordinated note here may be different from the term of the note between the company and the ESOP where it's buying stock separately. But this, perhaps with the bank involved providing some cash, would be a typical seller-financed ESOP transaction with maybe some bank financing to go to 100% ESOP ownership. And as we see, the shareholders are getting as part of their consideration for taking a subordinated note, part of their consideration is that they are going to get a warrant attached to that note, which is to say a piece of the future performance of the company. And so therefore we're addressing one of what would otherwise be one of the fundamental objections that a lot of sellers would have to this form of transaction, which is, every lawyer and accountant in the world will tell you, gee, you shouldn't really want to take a seller note in consideration for your stock. You ought to be getting cash or something else. And what we're saying is, yeah, you're going to get a seller note here, but it's going to have some equity-like attributes through issuance of the warrants. It's not going to be the typical junky seller note we might see when somebody's trying to buy a company on the cheap, and they're sort of having a nice price attached, but it's a lot of money paid up over a lot of years with a low interest rate. So this is our alternative here. And in a C corporation transaction, imagine we are a C corporation. Maybe our shareholders want to defer capital gains tax on the transaction, and eventually we want to get to a S election. We may have a bank loaning us money in what we would call a one-day loan to the company, and the company is then mirror loaning, making a loan to the ESOP. The ESOP's buying stock from the shareholders, and the shareholders are then lending the money back to the company in a subordinated loan and receiving back a note, again with warrants. So again, the shareholders end up at the end of the day here with a subordinated note with warrants, and the company simply hands the money back to the bank at the end of the day. So the money here has made a long round trip, usually electronically, usually in a matter of minutes. But again, at the end of the day, what we have is a shareholder selling their stock such that the ESOP will become the owner of all the stock of the company, and the shareholders, instead of holding stock, will have replaced their stock, perhaps in part with cash if we've also gotten a regular loan from a bank, but also significantly with a subordinated note with these warrants attached. So hopefully these diagrams are somewhat remedial. I assume we probably have a fairly ESOP-savvy audience here. I'm going to stop for just a second. Anybody who wants to weigh in with the chat if they have any questions or comments so far before we move on to some of the specific mechanics around warrants. Okay, seeing no chatted questions here, we will keep on going. So why are we using warrants in these seller-financed transactions? Well, first of all, we know that anybody who's looking to sell stock in their company is evaluating whether to do an ESOP transaction in comparison and alternative to the other things he or she might do with their ownership interest in the company. So an ESOP, if you will, has to compete, if you will, with other liquidity transactions. And of course, one would note typically that ESOP transactions are seen widely as having some virtues from the point of view of intangible goals, preserving the legacy of the company, keeping the company going independently, rewarding employees and the like. They're seen as having a tangible, non-monetary positive result, potentially for a selling shareholder whose desire is to remain significantly involved with the company and who wants to disconnect the liquidity process from the succession or the departure process. But ESOPs are seen somewhat negatively in that typically there is less cash available to a selling shareholder at closing than there might be in a purchase by a third-party buyer such as a private equity fund. And most of the time, if we're trying to structure an ESOP buyout, the company lacks the ability to pay a market-based return on a subordinated note to the seller in current cash, because current cash would mean rates of return at least north of 10% and maybe approaching 15% or more. And a lot of companies simply don't have a rate of growth or success to support that return as a cash payment. And often we see seller notes issued at lower interest rates that don't fully compensate a selling shareholder for the risk associated with the subordination and the lack of security. So the warrant acts as that additional compensation. If we structure our warrant correctly, the risk-reward profile of the note plus a warrant ought to be equivalent to the risk-reward profile of continuing to hold stock. So from a selling shareholder's point of view, we certainly have the notion that they are not getting an immediate liquidity event, but that the staged liquidity event has the same risk-reward profile as either holding on to the stock or selling it to somebody else. And finally, warrants are a particularly nifty thing in the 100% ESOP structure, because we optimize ultimately the underlying company, which is of course the real source of wealth here, because the company is able to service debt and doesn't have to pay any taxes in the process. So money that we used to be either paying directly to the government or paying indirectly to the government via distributions to our shareholders to pay taxes are now available for debt service or company growth. We also see the benefit here of employees getting an ownership interest, and we finally see that selling shareholders are getting treated equivalently, whether they hold the stock, sell to the ESOP, or sell to somebody else. And finally, there's another reason, I don't really have it listed here, but warrants really work particularly well here, which is, as we'll see later, warrants are really treated ultimately as creating an additional capital gain for a seller. Now, if both parties to the transaction, the corporation and the seller, are currently paying normal income taxes, if we had a normal company and a normal seller, the company is very focused on getting a deduction for making interest payments. And so, given a choice between paying an interest payment or a warrant, the issuer corporation would choose to pay interest because it's tax deductible. So a lot of mezzanine instruments, issued by normal companies to a mezzanine lender have a very high cash rate of interest, tax deductible interest, and a low level of warrant. Whereas the seller would prefer more warrant because it's more capital gain perhaps. Here we have a corporation that doesn't pay any taxes, so it's a little bit indifferent. It would much prefer to pay, it doesn't care whether it's paying interest or a warrant ultimately, but our sellers, of course, prefer to get their payments in the form of capital gain. So the instruments we typically see in seller-financed transactions tend to have relatively low coupon rate of interest, 2, 4, 6%, and relatively higher rates of warrants, reflecting the tax preferences of the selling shareholder and the tax indifference of the ESOP-owned S corporation. Again, any questions, concerns here so far? So as we said, we also do see warrants with subordinated mezz lenders. They want a higher rate of return, and they use the warrants, as I described, for a much smaller part of the total return than typical selling shareholder instruments. And the problem we have when we structure ESOP transactions is seller financing with low coupon payments and contingent payments based upon how the company does are generally going to be affordable. True third-party mezzanine lending with high interest coupons may be overwhelming from a financial point of view unless we're a very, very high-growth, high-performance company. So we do see some third-party mezz lending in ESOP transactions. But frankly, also we have a lot of selling shareholders say, gee, I'd like to get cash in the deal, but if I can take an instrument that has a projected return based on company performance in the 10, 12, 13, 14% range, boy, I look at the rest of the world and the rest of the marketplace, and that looks pretty good. So I think sellers, in some respects, not having great replacement investments for their, for the money they receive, are happy to often to hold some paper at a relatively high projected rate of return from the company. So the key issues when we're structuring and putting together warrants into a transaction, obviously we've got to figure out how the warrant relates to Section 409P. As we all probably know from our the rest of our ESOP lives, Section 409P says, in essence, that we cannot have too high a concentration of synthetic equity, meaning equity other than outstanding stock, in the hands of too few people. It treats anybody who's got a more than 10% interest in the combination of synthetic equity and things like warrants and stock appreciation rights with the underlying stock that they may come to own in the ESOP. It treats those people north of 10% as disqualified people, and then looks at whether those disqualified people own 50% or more of the company. And the short result of that is, when we look at issuing warrants, we better look at whether we are creating disqualified persons and whether those disqualified persons own more than 50% of the underlying equity of the company, because if we don't do that well, we can have what I have sometimes been known to call a nuclear winter with respect to the ESOP. So we have to worry about 409P. We want to look at the structure of the warrant. When is it exercisable? Under what terms? What puts and calls are there? We want to look at how to value the warrant. We have to decide whether the warrant is transferable, and we have to understand the underlying tax treatment of the warrant. So, okay, we've decided, we're going to do an ESOP transaction. We've decided that the seller is going to take back financing. And let's just take the, simplest example of, we have a seller who owns a company that's, in the eyes of all, including an independent appraiser, worth $10 million, hypothetically. And they've decided to take back $10 million in seller financing. And the question now is, what should be the interest rate, and how many warrants for what percentage of the company should they get? And we've really got two ways to do this. One way, which is the most common way and probably the large preference for how to consider how many warrants to issue,
is to say, okay, well, we think we can pay back perhaps our $10 million over 10 years, and we'll have the warrant exercisable in the 10th year. And so what we'll look at is we'll look at all the cash flows that the seller's going to get over 10 years in principal and interest payments on the $10 million of debt. And then we'll look at the cash flow we expect from the warrant exercise at the end of 10 years, guessing what the company will be worth then, based on an analysis of its then performance and valuation multiple, and take all of those cash flows to figure out what the rate of return is for the instrument. And we may have a target rate of return. Typically in a seller finance transaction, I would say the most common range is 10 to 14%. I've seen lower and higher under specific circumstances. But if our target return is hypothetically 12%, what we're really sort of saying is, what cash flow do we need from the warrant in year 10 to get us to a 12% overall return? And based on how well we think the company is doing and what we think the company will be valued at when the warrant is exercised, how many warrants do we need to issue such that when they're exercised in year 10, they produce this amount of cash flow? And that's the analysis of how to go about doing this. And an alternate is we can simply value the warrant as an instrument under Black-Scholes and treat that as a current dollar return and add that in conjunction with the overall cash flows, and again get to a total return on the investment. But most of the time we're doing an analysis of the future value of the warrant to figure out how many warrants can be issued. And this all is mildly complicated algebra, meaning it will make sense on a spreadsheet when explained, but it's a little hard to do at home. And as I said, we generally use the IRR method. We generally see 10 to 14, 10 to 15%. And we also understand that the underlying nature of the warrants, the other terms, really do have effect on the rate of return. We said warrants are synthetic equity under 409P, need to be analyzed. So now we have to look at the warrant structure and value, which is to say not only when do we expect the warrant to be exercised, but what other terms are attached to it. And first of all, we recognize that the value of a warrant, how desirable it is to have it, is a function, usually the method of valuing the warrant as an instrument is something called Black-Scholes. These are two guys who won Nobel Prize in economics a while ago for developing an option pricing model. And the key variables are what's the strike price relative to the current value, what's the exercise period, when can the warrant be exercised, is there a single date or multiple dates, and what is the relative volatility of the underlying stock value. Volatility, sometimes also referred to as beta. The more variation there is in the stock price, actually the more valuable the warrant can be, because you can have more chances of having an outsized return on it. So basically, if we have lower strike prices, longer and more delayed exercise periods, multiple exercise dates, and higher volatility, all will increase the underlying value of an option or underlying value of the warrant. But they all have a effect. They also make the rate of return on the warrant higher. So these are all interacting things. We can make the warrant more valuable, but presumably we'd have to issue more of them to get to a specific return. And the warrants we see in ESOP transactions, unlike a lot of other companies, we care pretty deeply that we don't actually have a warrant that ever really gets exercised and turned into stock in the hands of the warrant party. Most of the times the selling shareholder wants to get a cash payment equivalent to the value of the warrant. That's how they also get capital gains treatment. And we know the company doesn't really want to go below 100% ESOP ownership and have a minority shareholder that may want to hold, to receive tax distributions when the company makes money. So typically we have a holder put and a company call. The holder, when they can exercise the warrant, can say to the company, hey, in lieu of exercising the warrant, pay me the spread between my exercise price and today's fair market value. And the company has a call that says, instead of you exercising the warrant and getting the stock, we can pay you that spread between the exercise price and the fair market value. And again, another layer of structuring is whether the warrants are all exercisable at a single point in time, or whether we can have also a multi-year payout, either by note or partial exercise of any of the warrant pieces. And we do get the question that says, when the holder is paid the spread, do they get cap gains treatment? And the answer is yes. They are essentially selling this security, which is the warrant instrument, and they are getting essentially gain between their basis in the warrant and the amount that they receive, and that's treated as a capital gain. We'll talk a little bit more about that later. So we have to look also at setting the strike price for the warrant. What we know is when we did for instance, if we do a $10 million leveraged transaction in our $10 million value company, the fair market value of our company the day after we do this transaction is likely to be quite low. But we do have to follow the S corporation rules in setting the warrant strike price. And the IRS basically says that a warrant or option with a strike price below fair market value, meaning that it's in the money when issued, is really a second class of stock. And as we know in S corporations, that we can't be an S corporation with a second class of stock. Or in other words, what do you call an S corporation with a second class of stock? And the answer is a C corporation. So in an S corporation transaction we often see that the strike price is often the same as the post-leverage value of the company, or just slightly higher than the post-leverage value of the company, meaning we're beating the heck out of the stock price in our leverage transaction, and then we're issuing the warrant at that reduced price. And one of the complications we see is some folks like to do a simultaneous transaction where the company is redeeming stock for $10 million, issuing it to the ESOP for $10 million, but then the day after the stock's only worth, $100,000, and we don't want to issue the warrant until the point in time at which the stock price is treated as being lower, so you'll often see a couple days of low delay here. My own view of this is that the best way to avoid this problem is not to do simultaneous transactions. I think once we've redeemed the stock for $10 million, it makes a lot more sense to issue it to the ESOP from the company at the post-leverage value, and therefore we avoid the issue. And similarly, when we have a C corporation transaction, as we described, where we're eventually going to be an S, again, we may want to wait several days to actually issue the warrant so that we make sure that we've locked in the post-leverage price rather than the deal price as our strike price. So typically, an S corporation, as we said, an S corporation, ESOP, we don't want the warrant to be exercised, so we have calls from the company side where the company can purchase the warrant prior to exercise. Sometimes those calls are tied to a specific exercise date. Sometimes there are other dates on them. And we also have may have some restrictions on transferability of the warrant to eliminate the possibility that ineligible S corporation shareholders may exercise the warrant, meaning that if I get issued a warrant in an ESOP transaction the company may have a concern that I will transfer that warrant to my, to a C corporation investor who, if they exercise the warrant, which they might have the right to do, can blow up our S election. Now, we can just simply do it by some restriction and transfer rather than a full restriction. But basically, we want to make sure that our warrants never end up in the hands of an ineligible shareholder. We often do want, by the way, warrants to be transferable to facilitate estate planning. And one of the reasons why selling shareholders, getting a little bit off our formal presentation here, why selling shareholders love seller notes with warrants is because the day that the seller receives the warrant, it ain't worth very much, but we expect it to be worth a lot in the future. And therefore, warrants make particularly terrific securities for gifting to family as part of estate planning. I can gift it at a relatively low stated gift value, knowing that it has some likelihood of being very valuable in the future. So I can transfer wealth outside of the estate and gift tax limitations that might otherwise cost me some money. So now we get into, here is the ritual disclosure where I'm not about to give you any tax advice. You shouldn't rely on it directly. You should consult a tax professional, and so please take this as interesting information and not formal tax advice as we go along. And with that full and fair disclaimer, how are we going to tax all of this? And the IRS had a long history of viewing warrants and options as having no value or an uncertain value, and therefore not a tax event till exercise. And this is actually now in the Internal Revenue Code when we get options for services. If I issue Alice a stock option in SCS Advisors, she doesn't have any income on that option until she exercises it, when she then has, typically may have ordinary income at the end of the day. And so if we did that in the concept, in the context of the warrant would be treated as additional or contingent interest and result in ordinary income. But in the last 10, 15 years, the IRS and the courts evolved toward the view that warrants and options issued in conjunction with investment units can be valued when issued. And so we don't have a guidance on how to value it. There is a leading case, a Ninth Circuit case called Custom Chrome, which concluded that warrants for non-publicly traded stock are readily valuable, and that Black-Scholes and comparable investments were both reasonable methods. And the IRS did issue a technical advice memorandum about 6-7 years ago that said a warrant for publicly traded stock could be valued, citing Custom Chrome. I've never seen any IRS contest or anything in the literature that would suggest that one can't value a warrant for tax purposes, assuming one uses a reasonable method. Have not seen this come up at all in audit terms. Somebody, by the way, before I keep going, somebody asked the question, what typical call and put terms in ESOP deals? Typically, warrants are puttable, callable on the same date they're exercisable. That's basically the tie-in. The exercise date also is a put and a call. So that's the answer to that question. So back to tax treatment here. We actually have two different sets of rules that might apply here when we have a seller note with a warrant, depending on whether the debt and warrant is issued for a cash loan from the seller, as we saw in our C Corporation example, versus a debt and warrant issued in a pure redemption of stock. A warrant issued in exchange with debt in exchange for a cash loan, what we saw in our C Corporation transaction before, where there's a one-day loan that flows through to the ESOP, and then the ESOP loans the proceeds back to the company. In that situation, we are under the original interest discount rules with respect to the debt portion of the instrument. These are ungodly, complicated rules under the tax code that were designed to not let lenders defer the receipt of interest in tax event when they're getting a whole bunch of different consideration in a package. And that's Section 1273 of the code. And a warrant issued with debt in a stock redemption, the warrant is simply treated as additional consideration in the redemption based on the fair market value of the warrant, because it is a warrant issued with debt for property rather than for cash, and that's Section 1274. So fleshing this out a little bit, the IRS treats the warrant that's issued with a debt instrument in exchange for a cash loan as something that reduces the fair value of the loan and creates original interest discount relative to the face value of the loan. To reduce the very complicated to the simple here is it basically recharacterizes some of the payment, a small portion of the payment that would be labeled as return of principal paid by the company back to the lender, the seller, recharacterizes it as interest. So it basically shifts a small amount of principal payment, not taxed to the seller, to interest tax at ordinary income. And in a redemption, when we're issuing the warrant as a debt instrument for property, and we have additional consideration, what we end up doing is having to value the warrant on a fair market value basis and treat it as an additional capital gain paid to the seller on the date of the issue of the warrant. So to take these through into some examples, assume an ESOP purchases stock for $1 million, and the seller loans the $1 million back to the company in exchange for a note and warrants, and we determine using Black-Scholes or some other method that the warrants have a value of $200,000. Therefore, what the IRS says is, notwithstanding the fact that the company is going to want to pay back $1 million to our lender labeled as principal, the real loan that was made was only $800,000 because we got $200,000 in this warrant, and therefore $200,000 of the $1 million of principal gets treated as interest rather than principal. So we note here that the higher the value of the warrant, the more original interest discount we have, and the more of our principal flips over to being treated as interest, which most of the time we don't like. So that's the OID effect in our seller loaning the proceeds back to the company. And so for installment sales purposes, simply the warrant is treated as a payment of an installment and is subject to capital gains tax. So in fact, we pay capital gains on the $200,000 of the warrant up front, and then we convert $200,000 of the principal to interest. So essentially, essentially we've added $200,000 to the overall stream of taxable payments we're going to receive. And by the way, to answer the earlier question, we now have a basis in our warrant of $200,000, and if we exercise the warrant, we get a basis of $200,000 plus whatever we pay on the strike price. If we sell our warrant, our gain or loss is based on our basis of $200,000. If the actual payment for the warrant in year 10 turns out to be $500,000, we'll have a $300,000 capital gain. So obviously, the lower the value of the warrant here, the better off we are. Example number 2. This is back to our S corporation transaction that we illustrated earlier. And again, assume the company redeems stock for $1 million, and we redeem it by handing the sellers a $1 million note with stated interest at least the applicable federal rate. So we have to have at least regular interest and warrants. And the warrants here again have a value of $200,000. Here, the note does assume to have a value of $1 million, and the total consideration deemed for tax purposes to be received by the seller is $1.2 million. And the $1 million of note principal is treated as a capital gain on the redemption, either on an installment sales basis or the shareholder can elect out. And the $200,000 of the value of the warrant is recognized as an additional capital gain at the time of issuance. And again, this $200,000 becomes the selling shareholder's basis in the warrant for determining any future capital gain associated with the warrant. And again, an optimized result is the degree to which we can show the lowest ascertainable or defensible value for the warrant under Black-Scholes, because we'll have a lower tax recognition currently. But remember, we're paying capital gains up front on the value of the warrant when we receive it, but we're getting credit for whatever taxes we're paying up front on the back when we exercise the warrant, because we have some basis in the warrant. So it's a timing rather than a absolute dollar issue. Look at the view of the world from the fiduciary. What does a trustee think about buying a company, stock in a company that is issuing warrants along these lines? What do they want to know? First of all, when the ESOP is buying shares, they want to know that they're not paying more than fair market value. We want to make sure, of course, that the opinion of value that we're receiving from a financial buyer includes the warrant value, that we know that the warrants are ultimately dilutive, so we want them considered in our overall opinion. A fiduciary wants to make sure that what it's doing here is prudent, wants to make sure that the warrants are appropriate for the purpose. I think that there's been a lot of eye-rolling over some of the most aggressive folks who are out there trying to structure these 51%, 49% warrant deals where the ESOP's buying 100% of the stock, but there's a 49% warrant from day one. I think that raises all sorts of issues. We need to look also at the timing of the warrant exercise and how it fits in future cash flows, how it will relate to repurchase obligations, and whether we have the cash to do it. We really want to look at and make sure that we have adequate puts and calls so the warrant doesn't run forever. We want to make sure that the overall dilution is reasonable. We don't want to ever create a situation, if we can avoid it, when we have to start making tax distributions to new shareholders because we're now not 100% shareholder. We want, as a checklist, as a fiduciary, make sure that somebody's looked at and presented in a 409P analysis, and that we don't have any danger of losing our S status in the process. So this is sort of the checklist of things that a reasonable fiduciary might be looking at. A couple of more comments here, again, not so much in the slides, but when we're trying to structure these warrants and value them, and we're using a Black-Scholes method, typically, as we said in both of our examples, we have a secular preference that the value of the warrant be at its lowest possible reasonable ascertainable value. And the art in valuing a warrant is determining what rate of volatility to use in our assumption, where, as I said before, the lower the volatility rate, the lower the value of the warrant, the happier our sellers tend to be, and the less tax and OID and other issues are raised in that process. And so the question is, how do we develop a volatility rate for a Black-Scholes analysis? And one can try and do it from some comparable publicly traded instruments, but there isn't a whole lot of data. I would say generically one has to assume some level of volatility. I think a generic private company volatility rates, I would probably guess, range from 20 to 80%. These are measurements of how widely the value of the company is likely to vary. And I think that most of the time when we are valuing these warrants for tax purposes, we're working with our tax advisors and we're working with our accountants to argue for the lowest reasonable volatility we might assume in valuing the instrument. Somebody asked, generally, should we have the same concern with stock appreciation rights as with warrants? That's a parenthetical question, but stock appreciation rights have exactly the same financial attributes as warrants, and we ought to be looking at the same set of issues. Somebody else asked, can we have different warrant terms among the various selling shareholders? And the answer is yes. We just want to show that overall people are getting relatively the same financial return. So I've had some family groups sell where dad got a higher cash interest and a lower warrant position, and kids got a little less cash interest and a little bit more of a warrant position. Somebody asked, how do you include warrants in adequate consideration if they are issued at a strike price equal to fair market value? And my answer to that is the warrants have a value when issued at a strike price equal to fair market value. That's the Black-Scholes valuation, and we want to know that we're not undermining the value that the ESOP is expecting to receive for investing in the company. Financial accounting, somebody else asked financial accounting ramifications of ESOP warrants. I believe the warrants are treated as a footnote, but I'm sure there are CPAs who are much better qualified than I am to answer the question, so I'm going to defer to that. Last question I have so far here, going through the miscellaneous questions, is volatility and share value. The more volatility, the more likely that we're likely to have high share value at some point, and the more likely that a warrant, therefore, is to be more valuable. And somebody asked, is the warrant considered debt for the ESOP? Nope. Has nothing to do with the suspense account, has nothing to do with the debt accounting. Remembering that the ESOP is not the issuer of the warrant, the company is the issuer of the warrant, so it doesn't really relate to the ESOP's purchase and deleveraging and allocation of stock. So the chat's slowing down, which is good. Either I've answered people's questions or totally confused all of you. This is reasonably complicated stuff. This is probably the most complicated stuff we deal with in structuring ESOP transactions. Hopefully you've come away with a flavor for structure and tax treatment, but more than most things, I would tell everybody here, if you're putting together a transaction and you're trying to structure these things, this is truly a don't try this at home kind of set of instruments and considerations. You need to have probably mixtures of counsel, financial advisors, tax advisors, all understanding it, in order to help make sure that you're structuring something that actually meets the intended goals of the instrument and provides fair returns and fair outcomes for all of the parties. That being said, I'll claim victory. We did an hour webinar in 55 minutes, so either I talked real fast or hopefully was reasonably clear here. Want to thank all of you for attending. Anybody who would like a copy of the slides can email Alice Simons, who you probably have heard from already, and she will make sure to forward you a set of slides if you request. Anybody who wants to ask questions offline, feel free. You have my information. Thank you all for attending, and have a great day. So thanks much.